RealPage, Carl
Do it.
Whitaker has written a really nice report that talks about 3 types of apartment markets that could outperform in 2023. Just to overview the 3 types, and then we'll get into each one. College towns, markets with outsized job growth, and affordable low beta markets, which we'll get into kind of that definition. Just to kind of start out with college towns, and again, I also want to note that I like this again. This is they're putting themselves on the line, just like Berkadia is going to with their predictions. They're saying what they think is going to happen in the multifamily market, and I think it takes some confidence. So, with that being said, I'll begin with college towns here. So he didn't. Now, I haven't followed student housing as closely as market rate multifamily housing, but other than the fact that student housing charges per bed, but maybe deals with additional risks renting to messy students, I'm not as plugged in as I'd like to be. However, I think that a lot of college towns with large and robust universities, they're going to be fine. But I'm not sure that a given market will simply succeed because it is a college town. Some of the headlines about higher education make me think that there might be reduced demand for colleges in coming years. That could be years down the line. Maybe we'll see healthy growth in college towns for the next 5 years. But beyond that, there is a narrative. Now, I don't know how true it is, but there has been less demand for higher education. Some of the businesses are not hiring as many people. They're not requiring college degrees at the rate that they used to be. Now, these could be small little changes that are overblown because someone needs to write an article about it. But it does give me some pause, and there could be some changes down the line, especially when you're talking about if there's lower population of students in general, then
it's a good point, Matt. And I just pulled up some just like initial research because I was like, I'd be curious if that anecdote, lines up with what's going on in the field in terms of less people going to colleges because maybe that value, that return on investment isn't there. Mm-hmm. And, this is from Statista.com. Let's show what this actual source is. Well, we have to get anyway, so we'll confirm this source, but from Statista.com, undergrad enrollment in U.S. college universities has been dropping every single year. So you make a good point of just having a university in your town may not be enough of a driver. It might be okay. And I guess where I come back to is it's like any market. You never want to have just one industry. Yeah. One business, one factory, because that one factory either goes out of business or just, stalls and stops growing. You have too much concentration risk. But what I do think is very attractive is college towns with additional economic drivers in those college towns that may be linked some way, but not directly or inherently to the university or the college. That have other industries going on. They don't have to be huge industries, but you want to have, couple different cogs and gears in the machine. You just don't want one driver. You want to have, whether it's manufacturing, tourism, information, IT, tech, something else going on, because the university itself is going to have it's going to have spillover effects in terms of, there's support staff and there's going to be restaurants for the students and the staff. And there's going to, there's all of those crossover secondary, tertiary effects. But we all know the college town that just has the college and university, and it's like kind of stagnant, and again, thinking close to home, I'm thinking of like a Greencastle, Indiana, where like DePauw University is. I haven't checked the population growth on Greencastle recently, but I think it's relatively flat. But compared to a Bloomington or a Lafayette, West Lafayette, that has not only, universities, Indiana University, Purdue University, but, down in Bloomington, there's a variety of other industries, whether it's medical device manufacturing, advanced manufacturing, like mining from limestone, all the quarries down there, from the crane Naval Research Center that's down there that employs a couple thousand people, to Purdue, where they have this massive research and technology park, Alcoa, Subaru, a lot of other manufacturing. So there's a lot of other things going for that rather than just being a university, but the combination can really be a good recipe for success for a good market.
Yeah. And also I think that not all universities are going to be subject to the dire straits that may or may not happen in the next few years. What I've heard will tend to happen is the smaller universities that are not, kind of name brands. I think that DePaul will be fine as a university, but there are some that are significantly smaller than even that will fold. And other places like the research universities and these large kind of long-standing prestigious places where people continually go, things will be largely the same. It's not like every university will suddenly have 90% of their previous demand. It may be something like 10% of the worst performing colleges may not be able to operate.
That's a good point. And I believe there have been some universities like in the last year or two, small colleges or small universities that have shuttered the doors for exactly what you described, Matt. So very good points.
So those are the college towns. And then the next section are, and this is no surprise, but it is definitely worth mentioning because it's, if you don't mention it, it almost seems like it's downplayed. But markets with outsized job growth, those are expected to perform well in 2023. I think it's worth mentioning because not all of these markets with outsized job growth did particularly amazingly in 2020 through 2022. So those 3 years, San Francisco never did amazingly well. It had a bump up after doing very poorly in 2020 in the first half of 2021. But I
don't think San Francisco is an outlier because of other stuff San Francisco related. But agreed. Yeah.
But these markets like Dallas, Fort Worth, Miami, Las Vegas, New York, all of them had way different rent growth trajectories during the pandemic, but they all share this huge job centers. It's like, don't count them out. Something major has to go on to count them out for 2023 job growth. And I think Carl Whitaker rightly points out that even in the case of places like Las Vegas or Riverside, which have seen falling rent, the sizable job growth that they're still experiencing will keep these markets stable. Maybe almost like put a floor to these declines.
Yeah. Well, yeah, I agree. Just because of the amount of demand in those markets, and you may have years of oversupply because developers seeing that demand, but it tends to even itself out over time. You're seeing necessarily some of the markets. Well, Austin, I put like Austin and Phoenix. I'm looking here. And Nashville into the category of they've just seen so much explosive growth. They were all mid to large size markets that are getting bigger, mid, medium, large. And that's where you see that volatility of, you see a huge boom years like we saw in 2021. And now we're seeing in a lot of those markets, declines, and where, again, there's some markets that just behave a little bit differently. Again, it goes to show having a geographically diverse portfolio is a really smart way to manage risk and to limit volatility just within your multifamily portfolio itself. There's markets you're going to get great growth in certain economic conditions, and then other years where you're going to see some declines in growth in others, and there's going to be some that are just stable and some that are going to be volatile. And that's why you also want to be diversified through the different economic bands of multifamily as well, because different demographics behave differently in different economic conditions as well. So having some workforce housing and some A-class assets, I think is a smart move. The challenge is to the amount of work that is involved in building that type of portfolio. If we're just talking about a multifamily diversified portfolio, the different sponsors and opportunities you need to find, that can be the challenge.
Yeah, that and that is actually something that I was thinking of, is like, what are the robust jobs that are going to, what is that economic band that is going to be the most promising or the most stable and resilient in 2023? I think when you come to markets, and this is kind of skipping ahead or for the next section, which is these affordable low beta markets. This is the Midwest story that we've kind of come to welcome and expect. This has the steadiness that I was kind of referring to. He doesn't say that these are 100% Midwest by definition, but there's certainly a regional correlation. Cincinnati, St. Louis, Indianapolis, Kansas City, Cleveland are all in the top 10 markets for quarterly rent growth. But like the high job growth markets, they're not all the same. This is just going off the map. And I use an external source. There's an apartment list rent report, but Indianapolis has had more rent growth since the pandemic began than the other markets that are the other Midwestern markets here by a significant margin. So they may be all relatively low beta, which, as Carl Whitaker explains here, low beta implies that there's less opportunity for growth, but also less risk of decline. That may be true of some of them, but I think that there are others where you may have more of an upside than a downside. Specifically, I'm talking about Indianapolis, of course. They had more rent growth than places like Cincinnati, St. Louis, and Cleveland, or even Kansas City. But one thing that all of those markets have going for them is that the cost of living is lower, the rent to income ratio is lower, and there's lots of room for them to move up in rents. We talked last week about the kind of price convergence for rents, and if we are approaching this moment where people's wealth is winding down, they're drawing on credit a little bit more, their rent is becoming a little bit more of a burden for them, they're going to seek out, at least on the margins, seek out places where cost of living is cheaper.
Yeah. So, especially if you're someone who's looking at a more defensive stance, in general, whether that's now or always, I think some of these Midwestern low beta markets are great choice. And in general, when folks are looking to put multifamily as a piece of their portfolio, it often is a relatively defensive position in general, or at least the thought and the goal is defensive. And what ends up happening though is that you have the advantage of being in a very defensive position, investment that's tax efficient, throwing off cash flow, but you also often enjoy a lot of the benefits of growth as well, and some pretty attractive upside. And I think that can be the case regardless of where geographically you are investing. You can hit some home runs in the Midwest. You can hit some home runs in the Sun Belt. The chance for hitting home runs in the Sun Belt may be higher, but the volatility may also be higher as well. And so, again, thinking about building and constructing that portfolio, maybe it's a combination percentage of these high growth, high job growth markets that maybe you're going to have less cash flow, but you're hoping you're going to hit a triple or a home run on them with some cap rate compression. And then another percentage was 50, 60, or 40 of these just low volatility, higher beta markets, such as Indianapolis, Kansas City, Columbus, Ohio, Cincinnati, Virginia Beach. I wouldn't include. I'd throw Miami in the growth column for sure. I think Miami may be maturing a little bit. Miami has I'm sure there's going to be a slight correction in Miami, but it's not yet. There's still some people moving to Miami because I think that the pandemic really just solidified people's decisions to accelerate that retirement and moving from New York City down to Florida. I don't think a whole lot of people are moving back, at least from a permanent residency standpoint. There are folks that move to Florida from New York who are still going to be living in New York for just slightly less than half of the year, but their permanent residence is set up in Florida because they don't pay New York taxes. Who does?
Yeah. I agree. I think what I was thinking of when I was thinking of the jobs that may be more sought after or more resilient in 2023, but also kind of these markets will be more resilient in 2023. In an uncertain time, you kind of want to go to a place where there's a little bit less risk for a downside, and not only is there maybe less risk, but during these times, these markets perform better. It's not just that it's less risky. It's in the beginning of the pandemic when the market tanked. It was Indianapolis that was running to the top of the markets for rent growth. It wasn't like they were just steady. They were actually better than other ones. So this may be another year where these steady low beta markets are actually the highest growing markets, period. If we're in that
prediction,
uncertain,
Matt.
well, yeah, I know that's my hot take. I can't take in as many predictions and not give one of my own. So, and that's what Carl Whitaker says himself. He said, with expectations for a softer 2023, don't be surprised to see a few places, such as the aforementioned Midwestern markets, sneak into the top 10 for annual revenue growth by year's end. So I'm not alone.
No.
He may not say, he doesn't say Midwest, but I know what he means.
We know.
Yeah.
We know where he's going.
That's right.